The 1971 lie. By Sunday night, the gold was slipping away. Phones lit up across Europe. Traders were already betting the dollar would break. Inside Camp David, Nixon rehearsed a line he'd never thought he'd say: "We are closing the gold window." In a single stroke, money would no longer mean metal. It would mean policy. You didn't vote for it. You didn't even get an email. But that weekend would set the prices you pay, the assets that soar, the wages that stall. We'll trace the pressure that built, the closed-door choice, and the fallout you still live in, the oil deal, the wage freeze, and the new game of money. The pressure cooker before 1971. To understand that Sunday night, we need to go back to the math that stopped adding up. After World War II, the United States anchored a new system at Bretton Woods. The dollar would be as good as gold, fixed at $35 an ounce, and allies would peg their currencies to the dollar. It worked at first. Reconstruction, trade, and growth needed dollars, and America supplied them. But there was one problem baked into the design. Economist Robert Triffin warned Congress in 1960. The world needed more dollar liquidity to grow, but the more dollars the U.S. sent abroad, the weaker the promise to exchange them for gold at $35 became. That's the Triffin dilemma, and by the late 1960s, the numbers crossed a line. Foreign dollar claims stacked up to more than $60 billion. Meanwhile, at the official price, U.S. gold at the Treasury had fallen to around $12 billion. Do the ratio, roughly 2 to 1. If too many countries showed up at once, the vault couldn't keep the promise. Meanwhile, Washington kept spending. Vietnam costs mounted. The Great Society expanded. Deficits widened. At home, the whispers of inflation turned into a pulse in everyday prices. Unions negotiated hard to keep up. Wages pressed higher. Politicians promised growth without trade-offs. But the arithmetic was unforgiving. More dollars abroad, fewer ounces at home. Central bankers could see the stress in the gold market itself. In the early 1960s, the U.S. and European partners had tried to hold the line through the London gold pool, coordinating sales to keep gold near $35. In 1968, that pool cracked. The official market and the free market split into two tiers. On one tier, central banks politely pretended $35 still meant something. On the other, private buyers paid more. That gap was a neon sign. Confidence was slipping. Now shift to Paris. Charles de Gaulle had already made a point about monetary discipline. Under his successor, Georges Pompidou, France didn't just complain, it redeemed. A French warship, the training cruiser Jeanne d'Arc, was dispatched to New York Harbor to take delivery of French gold. It wasn't just symbolism. It was a bank run, performed with naval precision. Other countries followed with redemptions through quieter channels. Each ton that left the U.S. made the next redemption more likely. Inside the U.S. Treasury and the Federal Reserve, the scramble began. They arranged currency swap lines to buy time, urged allies to be patient, and cut bilateral deals to slow the drain. But those were patches, not solutions. Europe saw what was happening. By the summer of 1971, exchanges across the continent were closing temporarily as speculative flows surged, betting that the dollar would have to move. Here's the human angle. Picture a Midwestern manufacturer in 1970. Inputs priced in dollars, export orders priced in marks and yen, and rumors that the dollar might be devalued soon. Should he hedge? Should he delay shipments? Every decision got harder because the system felt like it was creaking. Meanwhile, a family in Cleveland kept a savings account earning interest that looked decent on paper, but prices at the grocery store and the gas station seemed to rise faster, numbers going up while life went down. You don't need to say Triffin to feel the squeeze. You just need to stand in a checkout line. The official line in Washington was steady as she goes. But Arthur Burns at the Fed faced an ugly trade-off: tighten to protect the dollar and risk unemployment in an election season, or stay easy and watch more gold drain away. Treasury Secretary John Connally fielded calls from finance ministers who were polite in public and blunt in private. They wanted assurance that $35 still meant $35. The math said otherwise. Meanwhile, something else was happening. The U.S. balance of payments kept bleeding. Dollars flowed out to pay for war, imports, and investment. That flow had been a feature, not a bug. Dollars abroad lubricated trade. But once the stock of foreign-held dollars towered over the gold base, the feature became a fatal flaw. The design assumed trust would hold. The market was now testing that assumption every day. By early August, the tipping point was clear. The free market price of gold was persistently above $35. The two-tier fiction couldn't be finessed forever. Every central banker understood the classic script of a peg under attack: either raise interest rates sharply, impose capital controls, or change the peg. But this wasn't a garden variety currency. It was the reserve currency, the keystone of the post-war order. Unknown to the public, the White House began shaping weekend plans. The calculus wasn't just monetary, it was political. Unemployment, inflation, a coming election, and a gold reserve that no longer covered the promise. The phone calls tightened into a circle. Connolly at Treasury, Burns at the Fed, Paul Volcker, the Undersecretary for Monetary Affairs, George Shultz at the Office of Management and Budget, and Nixon's inner team. They'd tried patches. Now they needed a decision. This was the moment everything changed. The risk wasn't losing a debate in a seminar room. The risk was a line of central banks at America's gold window on Monday morning. If they showed up, the vault would answer the question for them. So they made sure the window wouldn't open. The run on U.S. gold. De Gaulle to Nixon. 3 days after another tense cable from Paris, a gray hull eased past the Statue of Liberty. The French Navy's training cruiser Jeanne d'Arc wasn't there for ceremony. Under President Georges Pompidou, the Banque de France had filed redemption orders, dollars in, gold out, at the official $35 per ounce. It was a message with ballast. If the promise stood, honor it. If it didn't, everyone would see. From the French perspective, this was discipline, not provocation. De Gaulle had argued that reserve currency privilege tempted excess. Pompidou kept the posture but skipped the speeches. The ship, plus quieter pickups rooted through the Federal Reserve Bank of New York, made the point. Gold bars moved onto pallets. Clerks recorded serial numbers. The ledger shrank again. Yes, a literal bank run in slow-motion daylight. And in chancelleries across Europe, staffers circled the day. Meanwhile, something else was happening in London and Zurich. On the free market, where private buyers set the price, gold traded above $35. That premium said out loud what officials avoided. The peg looked artificial. If the metal fetched more in the wild than at the window, why hold dollars at par? Central banks are conservative, but they're not blind. One redemption begat another. Not every bank had a frigate, but every finance minister had a calculator. Inside the Treasury, John Connolly fought on two fronts, foreign and domestic. He called counterparts, urged restraint, and framed redemptions as unhelpful during a delicate moment. At the same time, he briefed the White House on the optics. Pictures of a NATO ally hauling away U.S. gold would not help in an election year. At the Fed, Arthur Burns weighed rate hikes. A sharp increase might defend the dollar, but it would also slow an already shaky economy. Paul Volcker, the tall undersecretary at Treasury, ran scenarios that ended at the same place. The stock of foreign dollar claims dwarfed the gold-based. European policymakers didn't move as a bloc. The Bundesbank preferred quiet negotiations. The Bank of England worried about sterling's own fragility. The Italians faced capital flight. But the shared conclusion was unmistakable. The anchor was slipping. To buy time, the U.S. leaned on currency swap lines, temporary dollar-for-franc or dollar-for-mark exchanges, to help partners meet liquidity needs without dumping dollars on the market. It helped at the margin. It didn't change the ratio. By early summer 1971, speculation stopped tiptoeing and started running, because once trust wobbles, speed is a strategy. Traders borrowed in weak currencies and bought strong ones, betting that official parities would snap. European exchanges shuttered for holidays that weren't about sunshine, they were about panic. In New York, the gold desk watched orders stack up. Each time the Treasury shipped bars, the rumor mill spun faster. Who would be next? How much was left? Here's a micro moment that captures the mood. A junior desk officer at a European central bank phoned a contact at the Fed, voice low, asking whether New York could accommodate a modest redemption next week. The reply was technically correct. Redemptions were still honored, but the pause before the answer said more. Monday mattered. Tuesday might matter more. What nobody outside the circle knew was the degree of coordination already underway at Camp David. The inner group, Connolly, Burns, Volcker, George Shultz, with Haldeman and Ehrlichman in the political frame, had wargamed a Monday morning line of claimants. If half a dozen central banks showed up together, the window would empty faster than anyone could draft a communique. That scenario wasn't abstract. The French order had normalized the act. Across the Atlantic, Japan watched nervously, because when the dollar sneezes, export models catch colds. Export competitiveness relied on a stable dollar rate, but persistent U.S. deficits and the gold drain hinted at a forced realignment. Banks held mountains of dollar assets. A sudden devaluation would hit balance sheets. In Bonn, officials balanced inflation fears against an export machine geared to a fixed world. Every path had costs. None restored the old comfort. Through July, the free market gold price refused to return to $35. The two-tier system, official at $35, private above, became a daily embarrassment. If authorities sold into the free market to press the price down, they fed the drain. If they stepped back, the private price rose and made redemptions look prudent. It was a trap of their own design, sprung by time. Then the week before the decision, the bleed accelerated, whispers turning into trades, trades turning into headlines. A discreet European redemption that would have passed unnoticed months earlier triggered a flurry of calls. Market makers widened spreads. Airlines booked last-minute cargo space. On the Friday, whispers suggested a coordinated move was imminent. Devaluation, control, something. Officials denied it. Traders didn't care. By Saturday morning, the choice hardened. The window could open Monday as if nothing had changed, or it could close. The French frigate had done more than carry metal. It carried a lesson. When confidence breaks, procedures become theater. The audience had seen behind the curtain. Now the stagehands would rewrite the play. The Camp David weekend, the closed-door pivot. They drove up in pairs, the way people do when they don't want to be noticed. Pine trees, a humid August sky, and a lodge that had hosted wars of a different kind. Inside, Richard Nixon set the tone. No leaks, no delays, and no Monday morning line at the gold window. Around the table sat Treasury Secretary John Connolly, a Texan with courtroom swagger, Arthur Burns, the Fed chair with a furrow that said he hated inflation and politics in equal measure, Paul Volcker, the lanky undersecretary who knew the ratios cold, George Shultz, the budget man with a systems brain, and the political enforcers, H.R. Haldeman and John Ehrlichman, watching the angle. The first question wasn't philosophical, it was arithmetic. Volcker laid out the sheet. Foreign dollar claims now ran multiples of what the Treasury could redeem at $35 per ounce. The free market price stubbornly sat above the official peg. Europe had shut exchanges to catch its breath. If central banks came together on Monday, the remaining U.S. gold would walk. Burns added the domestic bind. Hikes big enough to defend the dollar would slam the economy in an election year. Connolly cut in. We can't raise rates to save a promise that can't be kept. They walked through options like firefighters mapping a building. Option 1, devalue the dollar against gold, maybe to $38 or $42, and hope the market would buy the new number. Problem, once you admit the price is wrong, you invite another run to test the next price. Option 2, capital controls and tight money to choke off outflows, with the political cost of visible pain. Option 3, suspend convertibility temporarily, promise negotiations, and pair it with a package that tells voters we're on their side. Schultz pressed the coordination angle. If they slammed the gold window alone, allies would call it a breach of Bretton Woods. If they did it with a broader program, something that looked like a reset, the outrage might be manageable. Burns wanted assurance that temporary wouldn't mean a free-for-all. He'd watched wage settlements chase prices and prices chase money. If they cut the gold anchor, policy had to grab another lever. Connolly, ever direct, suggested shock therapy, 3 moves at once. Close the gold window to stop the bleed. Freeze wages and prices for 90 days to signal discipline and break the psychology. And slap a 10% import surcharge to force trading partners to revalue, shifting relative prices without waiting for them to act. Haldeman liked the politics, a hard line against speculators, a patriotic frame, and something simple enough to sell on TV. Ehrlichman flagged the legal questions. Under Bretton Woods and the IMF articles, suspension could be argued as temporary in the national interest. The surcharge fell into the gray area of emergency powers. They debated the word temporary like it was a binding contract. Burns wanted a path back. Connolly wanted room to maneuver. Volcker warned that credibility would now ride on domestic discipline because the metal backstop would be gone. If they bungled the next months, inflation would embed deeper. Schultz tied it together. Sequence matters. Close the window, announce the freeze, impose the surcharge, and convene talks for a realignment of exchange rates. Then, in the background, prepare a case for a new system if the old one couldn't be revived. Nixon stepped in when the room drifted toward caution. He didn't want half measures. He wanted an outcome that guaranteed there be no humiliating scene at the New York Fed vault. He rehearsed the line he'd deliver. This wasn't surrender. It was defense against international speculators and unfair foreign practices. Connolly promised to handle the allies. He'd famously tell them, the dollar is our currency, but it's your problem. Burns asked for teeth to rein in price spirals, and Nixon gave him the freeze. Volcker asked for the import surcharge to be clearly transactional, lift it when partners revalued. Schultz drafted the choreography right down to the order of paragraphs. They ran the schedule like a broadcast, because selling a shock is half the shock. Saturday, lock the decision, draft the speech, pre-brief a few key Hill figures to avoid a revolt. Sunday morning, final legal scrub, Treasury and the Fed coordinate messaging to banks and foreign central banks. Sunday evening, a nationwide address from the Oval Office, framed as a bold new economic program to protect jobs, prices, and the dollar. After the speech, calls to Bonn, Tokyo, Paris, and London, explanations heavy on necessity, light on apology. In a side room, Connolly and Volcker gamed the Monday market open. Banks would need guidance, settlement procedures, messages for correspondent accounts, and clear language that official redemptions at $35 were suspended. The New York Fed lined up staffing. The White House lined up applause lines, wage and price controls, a patriotic appeal for cooperation, and the promise of stronger growth. They even discussed how the camera would catch Nixon's reassurance. Here's the quiet beat that mattered. They accepted that money, the way the world had defined it for a generation, would now mean policy. Not metal, not an automatic discipline, but choices, rates, controls, taxes, deficits managed by people in rooms like this. That carried risks they could feel in their bones. It also gave them room to breathe on Monday morning. They took the room. The Sunday night shock. The announcement. Good evening. Nixon looks into the lens and starts with reassurance. He calls it a bold new program for prosperity. Then the line they'd written and rehearsed. The United States will temporarily suspend convertibility of the dollar into gold. No timetable, no end date. From that moment, foreign official holders could no longer bring dollars to the Treasury's window and receive metal at $35 an ounce. The promise that had defined the post-war order was paused with a single adverb. He doesn't linger. He folds the move into a package designed for living rooms, not trading floors. A 90-day wage and price freeze across the board to break the back of inflation. He frames it as fairness. If government acts, everyone will do their part. Then the kicker for foreign capitals, a 10% import surcharge. It's not called a tariff. It's described as a temporary charge to offset unfair exchange rates and to force partners into a realignment. The message is clear. If you won't move, we'll make you. He threads the whole thing with a villain, international speculators, a simple story for a complex break. Not allies, not policy, not arithmetic speculators. He says this plan will protect the dollar, protect jobs, and protect the American consumer. The word protect lands like a shield. In the control room, Connolly smiles. The freeze will play with voters. The surcharge will play with factories. And the suspension, wrapped in temporary, will stop the Monday run. While that framing hits TV audiences, a second script races through secure phone lines. Treasury informs central banks that official redemptions are suspended effective immediately. The New York Fed prepares talking points for correspondent banks. Settlement mechanics stay the same, but the keystone, gold at $35, is gone. In Bonn and Tokyo, officials stare at the same sentence and then at each other. Temporary is doing a lot of work. Markets don't open that night, but expectations do. In Europe, finance ministries convene emergency sessions. Some plan to close exchanges, an emergency holiday that screams panic without saying the word. Others game out new parodies. Traders who'd bet on a break feel vindicated. Those who trusted the peg feel exposed. On Monday, the two-tier gold reality becomes official. There's the old price that no longer trades and the free market price that will find its own level. At home, the reaction splits. Labor leaders welcome the freeze. Price controls promise relief from grocery bills that felt like they moved without reason. CEOs applaud the surcharge. It buys time against foreign rivals. Households hear that the dollar is protected. The applause lines land. But underneath the speech, money has changed its meaning. It's no longer a claim on a weight of metal. It's a claim on policy, adjusted as conditions and politics demand. Allies feel blindsided. Paris notes the irony. London swallows hard. Tokyo, heavily tied to U.S. trade, calls for calm while scrambling to defend its banks. The surcharge stings, the process stings more. Bretton Woods had been a club. Tonight, the chair of the club acted alone and told others to adapt. The fix is labeled temporary. Within months, it becomes the new normal. From gold
Temporary
to fiat,
policy becoming
redefining
permanent.
money. By Monday morning, the promise had changed. A dollar was no longer a quiet ticket to gold on demand. It was a claim the government would manage. That sounds abstract until you see how fast behavior shifts when the anchor is policy, not metal. Start at the bank counter. Before, the system's base was an asset, gold, that didn't care about elections. After the window closed, money's base became credit created inside the banking system. When a bank made a loan, it didn't hand over pre-existing cash. It created new deposits with a keystroke. The Federal Reserve's job wasn't to defend a peg anymore. It was to steer the price of credit, interest rates, so the growing web of loans and deposits didn't spin out of control. That new foundation carried a different kind of discipline. Instead of bars in a vault limiting expansion, it was the willingness of households and businesses to borrow, and the Fed's appetite to tighten when prices ran. When inflation ticked up, you didn't expect a gold shipment to change incentives. You expected policymakers to raise rates, guide expectations, or, if things got rough, improvise. Meanwhile, the psychology of saving took a hit. In the 1960s, a passbook account felt like a safe, if dull, bet. In the 1970s, the Consumer Price Index rose faster than many bank interest rates. That meant negative real yields. Your purchasing power slipped even as the number of dollars in your account crept higher. Savers learned that safe could quietly be costly. The lesson stuck. Decades later, during long stretches of policy easing, real yields turned negative again, a repeat pattern that still shocks savers who think interest means gain. Savers were subsidizing borrowers. People adapted. If cash lost ground, you bought things that held value or produced cash flows. Real estate wasn't just a roof, it was a hedge. Stocks, especially those linked to companies with pricing power, became savings plans in disguise. Commodities found new fans. Policymakers, seeing the problem for retirees and cautious savers, later introduced tools like Treasury inflation-protected securities, bonds that adjust their principal with CPI to blunt the squeeze without saying the quiet part out loud. That was an admission. In a fiat world, protection against inflation had to be engineered. The new rules also changed the scoreboard between workers and owners. Through the 1950s and 1960s, productivity gains broadly flowed into paychecks. The graphs moved in tandem. After 1971, the lines began to drift apart. Productivity kept rising, powered by technology and global supply chains. Median real wages, adjusted for inflation, flattened for long stretches. You can see it in those "What Happened in 1971" charts. One line climbs, the other wanders. Households filled the gap with more hours, two incomes, and crucially, more credit. Inside boardrooms, the toolkit expanded. If money was policy and policy could be predicted, or at least read, then financing became a strategic lever. Lock in long-term fixed-rate debt before the next wave up in rates, and inflation would do part of your work by eroding the real burden of what you owed. If rates fell, refinance. If liquidity surged, buy back shares or acquire rivals. The balance sheet became as decisive as the factory floor. Here's where the human story sneaks back in. A nurse opened a savings account for a down payment and watched prices move faster than the interest posted in the window. A small landlord refinanced a 30-year mortgage when rates dipped and found that, over time, the rent rose with inflation while the payment didn't. A machinist noticed that the company's profits swelled in a boom, but raises lagged while the stock plan did the talking. Each of those choices flowed from the same shift. Money was now elastic, and policy set the stretch. For the Fed, the absence of gold's constraint wasn't freedom without cost. It was responsibility without alibis. When inflation surged later in the decade, they couldn't point to a broken peg. They had to break expectations. That would come with its own drama. But even in calmer years, the quiet math changed. With money untethered from metal financial cycles, credit expansions and contractions became the rhythm policymakers watched. Rates moved not to defend a number, but to defend a narrative. Growth with stable prices. The cultural story edged along too. Cash is king still sounded right, but only if king could keep up with prices. People learned a new language: real versus nominal, yield curves, duration, risk. They tracked central bank press conferences the way farmers watch clouds. A hint about accommodative policy could lift markets. A line about being resolute could sink them. In place of a fixed conversion, there was a moving conversation. There was one more missing piece, and everyone in those rooms knew it. Gold had been the anchor that compelled foreign demand for dollars. Without it, the world would need a reason, stronger than habit, to hold and use the currency at the center. That reason wouldn't be found in vaults. It would be found in barrels. And the deal that bound oil to dollars would turn policy into architecture. The petrodollar deal. Oil as the new backbone. 3 years after the window slammed shut, the new anchor took shape in quiet rooms with thick carpets. The premise was simple. If the world needed dollars to buy the thing it couldn't live without, oil, then demand for dollars would endure without gold. The execution ran through Riyadh and Washington and through a statesman who understood leverage. The oil shock of 1973 had already introduced pain. OPEC's embargo sent prices lurching higher, rationing hit drivers, and policymakers realized energy could topple cabinets. Meanwhile, the dollar floated, wobbling without a metallic backstop. Stability needed a bridge. Henry Kissinger worked the phones and the shuttles. What followed became known in headlines as a milestone pact, a U.S. Saudi economic and security arrangement that would, in practice, make oil a dollar business. Here's the architecture. Saudi Arabia, the swing producer with spare capacity and outsized influence in OPEC, would invoice its oil exports in U.S. dollars exclusively, a practice that hardened from 1974 onward through U.S.-Saudi security and economic agreements. In return, the United States would provide security guarantees, advanced weaponry, and a tight political relationship. The surging oil revenues, petrodollars, wouldn't sit idle. They'd be recycled into U.S. treasuries and other dollar assets, earning a return while deepening the market that financed American deficits. No treaty spelled every clause in neon, but the pattern hardened quickly. Oil priced in dollars, surpluses parked in dollars, a loop that fed on necessity. From the Saudi side, the logic was clean. Pricing in a single, liquid currency reduced transaction frictions and FX risk. A deep dollar bond market offered a place to store national savings. Security from the globe's premier military power lowered existential worries. From Washington's side, the benefits arrived in layers. First, universal dollar invoicing for oil forced every importer, from Europe to Asia, to hold dollar reserves. Second, those reserves found their way into treasuries, supporting a larger, cheaper U.S. borrowing capacity. Third, energy trade knitted geopolitics to finance. Decisions in Riyadh rippled into yields in New York. Meanwhile, something else happened in the pits and on the screens. As the decade wore on, oil markets matured. Futures exchanges grew, benchmarks gained authority, and derivatives multiplied. NYMEX and later ICE contracts turned crude into a financial instrument whose price intertwined with interest rates and the dollar's strength. When the dollar rose, commodities often felt pressure. When rates shifted, the curve kinked. It wasn't conspiracy, it was plumbing that quietly rerouted power. A dollar world meant dollar sensitivities. The effect showed up in central bank balance sheets far from the Gulf. Importers needed working balances of dollars to pay monthly cargoes. Exporters needed vehicles to invest windfalls. Eurodollar markets, the offshore dollar system, swelled as banks intermediated flows between producers and consumers. The petrodollar, first a headline, became a habit. By the late 1970s, energy ministers and finance ministers were effectively playing on the same field, even if they wore different jerseys. There's a human thread here too. A factory in Osaka bought crude priced in dollars, hedged its exposure with dollar futures, and passed some costs into yen prices. A family in Milan watched heating bills depend on an exchange rate they didn't control. A banker in London arranged a syndicated loan for an emerging economy that earned pesos but owed dollars. Good times felt fine. Bad times meant sudden stops. Oil's dollar backbone transmitted both stability and fragility. Critics later called the arrangement lopsided. Supporters called it pragmatic. What mattered was the feedback loop. Oil priced in dollars sustained global dollar demand. That demand kept U.S. Treasury markets deep. Deep markets anchored the dollar's reserve status. Reserve status reinforced the case for dollar oil. Round and round. Each turn made it harder for rivals to dislodge the system without building a comparably safe, liquid alternative. Kissinger didn't sell it as empire, he sold it as order. And for a world rattled by embargoes, inflation, and floating rates, order had a price. Arms packages moved, F-15s and air defense systems became part of the deal's visible spine. Intelligence coordination thickened the invisible part. The Saudis got protection and a predictable financial home. The United States got a global billing system for energy that ran through its currency and its bond market. By the mid-1970s, the map of money looked different than it had under gold. At the center no longer sat a vault, it sat a barrel. The peg had turned into a practice. The reserve had turned into a relationship. And with energy securing demand, the next lever, debt, was ready to do the heavy lifting. Debt Ascendant, the new economic engine. With oil securing demand for dollars, debt stepped forward as the system's muscle. Government borrowing stopped being an emergency valve and became a standing feature. Petrodollar surpluses cycled back through New York into U.S. treasuries, deepening the market that would finance every deficit, from recessions to wars to tax cuts. The buyer base widened, central banks, sovereign funds, pensions, and the habit hardened. When trouble hit, issue more bonds. The reserve currency had found its flywheel. Households learned the rhythm in their mailboxes. The 1970s birthed mainstream credit cards, and revolving balances replaced the layaway culture. Mortgages stretched from 20 to 30 years, then added exotic cousins when rates swung. Student loans scaled up as tuition outpaced wages. The shape of a normal life bent around monthly payments: car, house, school, healthcare, each a pipeline that turned future earnings into present spending. The upside was access. The downside was leverage. That bit when policy tightened. Corporations rode the same arc with sharper elbows. In boardrooms, the balance sheet moved center stage. When rates fell, treasurers refinanced. When liquidity was cheap, they borrowed to repurchase stock, lift earnings per share, and tilt rewards toward owners. Mergers financed with bonds reshaped industries. The financial sector swelled to serve the demand, creating layers of intermediation: money market funds, securitized mortgages, high-yield desks that tethered more livelihoods to the price of credit. Each layer made the dollar system heavier and, paradoxically, easier to move with a single lever: rates. Interest rates, once tools to defend a peg, became the thermostat of the entire house. In 1979-1981, Paul Volcker's shock reset expectations with punishing hikes. Factories closed, unemployment jumped, and inflation broke. The lesson stuck: if prices ran hot, the Fed could cool them, no gold required. Later chairs added new instruments. Forward guidance turned sentences into signals. Quantitative easing used the Fed's balance sheet to compress long-term yields when short rates hit zero. Swap lines stitched foreign funding markets to the Fed's spigot, extending lender of last resort powers beyond borders. Meanwhile, the bond market's depth reinforced the dollar's dominance. Every crisis pushed more savers toward treasuries as the cleanest collateral. Dealers financed inventories in repo markets built on that collateral, and the overnight price of money linked to Washington's IOUs. When oil exporters, Asian surplus nations, or European insurers needed a liquid home, they bought the same paper. That convenience shaped policy option. If a downturn loomed, fiscal policy could expand, confident that auctions would clear and the central bank could smooth the path. But cheap money carried its own gravity. Each expansion required more credit than the last to deliver the same unit of growth. Debt loads ratcheted up, while interest costs were held down by design. Negative real rates, interest below inflation, did political work. They eroded debt burdens quietly, taxed cash holders invisibly, and rewarded borrowers, including the government. Savers who stayed in deposits paid for the glide path. Owners who held duration or real assets gained. On the ground, the pattern showed up as a boom-bust cadence. Easy credit and rising asset prices lifted construction, hiring, and confidence. Then came a policy turn or an external shock, a tightening in credit standards and a slide. To arrest the fall, authorities cut rates faster, provided guarantees, or expanded balance sheets. The Greenspan era set the expectation that markets wouldn't be allowed to clear violently. The 2000s extended it with a housing boom fueled by securitization and global savings gluts, followed by a bust that triggered quantitative easing on a historic scale. The COVID years fused fiscal and monetary firepower, wiring cash directly to households and backstopping credit markets within days. Meanwhile, corporate strategy adapted to the new certainty. Central banks would lean against collapses. That implicit put encouraged risk-taking at the margins. Private equity relied on leverage as a design principle. Public firms optimized capital structures to minimize weighted average cost of capital, often at the expense of resilience. Bank treasuries rode duration in safe assets. Confident liquidity would arrive if needed. The more the system relied on intervention, the more intervention it required to stabilize. Here's a micro-story that captures the era. A manufacturer took out a 10-year bond to automate a plant. Productivity rose, headcount fell, margins widened. When a downturn hit, orders dried up, but interest costs stayed fixed while rates dropped. The firm refinanced lower, cut a deal with lenders, and survived. Across town, a family with a variable rate mortgage saw payments jump when the cycle turned the other way. One balance sheet had room to maneuver, the other had none. Same dollar system, Different consequences. The political economy evolved alongside the plumbing. With treasuries at the core of savings and collateral, fiscal debates were no longer about whether to borrow, but how much and for what. Monetary debates were about pace and coordination, how quickly to hike, how slowly to unwind, whether to signal or surprise. Independence blurred under pressure. When markets wobbled, phone lines between finance ministries and central banks hummed. The aim wasn't a price of gold anymore. It was a path for everything else. Inflation in this world wasn't just a number on a screen. It was a redistribution machine. It shifted wealth from cash holders to asset owners, from late borrowers to early borrowers, from fixed incomes to flexible revenues. The post-1971 design had granted policymakers room to lean, but it also wired incentives to use that room again and again. Debt had become the engine. The fuel was confidence that tomorrow's buyers would show up. The meter was set at the central bank. The silent squeeze. Wages, prices, and the middle class. The squeeze didn't arrive with sirens. It drifted in through pay stubs and price tags. After 1971, productivity kept climbing. Better machines, better software, global supply chains snapping into place. But median real wages stopped marching in step. The famous chart shows it plainly. Output per hour rises like a steady escalator. Typical pay flattens and wobbles. At kitchen tables, the translation was simple. It took more hustle to stand still. Housing told the same story with fewer decimals. In the 1960s, a median earner could buy a median home with roughly 2.5 years of savings. By recent decades, that stretched towards 7 years or more. The sticker shock wasn't only about land or lumber. It was the design of money nudging returns toward assets. Low or negative real rates quietly boosted valuations. Mortgages lengthened. Down payments chased prices. Owners with fixed-rate loans watched payments stay put, while rents and replacement costs climbed. Renters paid the spread. Meanwhile, core costs outran pay. Healthcare premiums rose faster than inflation, then deductibles sprinted too. Tuition leapt ahead of both, turning grants into loans and loans into timelines that lasted into middle age. A nurse who'd once saved for a starter home now serviced student debt while rent rose. A teacher's contract bumped 2% a year while childcare rose 5%. The math didn't argue, it accumulated. Households adapted the way systems do, with more throughput. One income became two. Overtime patches filled gaps. Side gigs turned weekends into ledgers. For many families, total household income rose not because each hour was paid more, but because more hours were counted. At the same time, the social compact around retirement shifted. Defined benefit pensions that promised a check for life faded. In their place came 401(k), S, and IRAs. Defined contributions whose outcomes depended on market mood, fee drag, and the luck of when you retire. That shift, risk moving from institutions to individuals, made policy feel personal. A rate hike wasn't just a headline, it was a portfolio mark and a mortgage quote. A bout of QE wasn't just a balance sheet entry, it was an equity rally that decided whether your 2035 target date fund looked on track. Savers learned a new rule. Prudence meant owning productive assets, not stacking idle cash. But not everyone had the margin to buy those assets. The ladder tilted toward those already on it. Asset inflation rewarded the already invested. A landlord with a fixed mortgage saw equity swell as rents shadowed wages and replacement costs. A small business owner with pricing power kept margins while units moved. Meanwhile, a renter paid more each year, never closing the distance to a down payment because the goalposts moved. A retiree parked in CDs earned safety and a haircut in real terms. Policy didn't instruct this outcome, incentives arranged it. Politics tried to narrate the pain through culture and choice. Work harder, learn to code, stop buying lattes, but the charts kept pointing back to the plumbing. When money is steered by policy and rates, and when negative real yields recur, the system channels value into assets and away from static cash. That isn't a conspiracy, it's an operating system. There were bright spots that looked like exceptions and were, in fact, illustrations. A couple who bought a modest house in a dull neighborhood in the early 198s rode mortgage rates from the teens down to single digits, then refinanced again in the 200s. Their payment fell in nominal terms, even as their wages rose a bit and prices rose more. Equity built from amortization and appreciation. Next door, a new arrival to the city, a decade later, faced prices set by that history, not by their pay. Timing became a character in family stories. Labor's bargaining power shifted under the surface. Global supply chains expanded the pool of workers effectively competing on the same assembly line. Technology unbundled tasks and automated the routinized ones. Unions lost density. The share of national income going to labor slipped while the share to capital nudged up. Corporate profit margins firmed. Stock-based compensation blurred the line between wages and ownership for a slice of workers near the top, widening gaps inside payrolls themselves. This wasn't uniform. Some sectors, energy, specialized trades, certain services, kept tight markets and strong wage growth. Regional booms lifted boats in their harbors, but the national median told the broader tale. Productivity up, typical pay flat, essential costs climbing faster than the CPI basket suggested if your life included kids, college, and a doctor. The index was honest. Your mix was harsher. Underneath, the post-1971 design kept doing its quiet work. Each cycle leaned on more credit to steady growth. Each rescue pulled forward returns. Each period of low real rates made tomorrow's dollars worth a little less than today's debts. Owners planned around it. Savers learned too. Those who couldn't or wouldn't felt the squeeze most. And yet people adjusted because that's what people do. Skills upgraded. Side businesses bloomed. Families pooled resources. Communities built informal safety nets where formal ones shrank. The story wasn't only loss. It was adaptation under a set of rules no one voted on one
Global
Sunday
ripples,
night, but everyone lives by crises and currency wars. While that new dollar engine revved at home, something else was happening across the map. Countries that could sell to America leaned into exports, pegged or managed their currencies against the dollar, and watched factories hum. Europe rebuilt with a bias toward competitiveness. Japan turned efficiency into culture. Surpluses piled up, and with oil priced in dollars and treasuries the cleanest parking spot, central banks recycled earnings back into U.S. debt. The loop tightened. Sell goods, earn dollars, buy treasuries, keep the dollar bid, sell more goods. But pegs come with choices. Keep your currency weak enough to export, and you import the Fed's policy, easy money when Washington eases, tightening when it tightens. Germany learned to jawbone inflation while running a machine that needed foreign customers. Japan accepted a high-saving, low-consumption model because the external surplus felt safer than the domestic boom and bust they feared. In both cases, central banks leaned against appreciation by buying dollars. Balance sheets swelled with U.S. paper. Emerging markets saw the path and sprinted, industrialize, attract capital, peg to the dollar and borrow offshore to bridge the gap. The catch hid in the billing. A steel mill in Sao Paulo earned reais but owed dollars. As long as growth ran and the dollar stayed tame, the math penciled. When the tide turned, debt service ballooned overnight. The Latin American debt crisis in the 198s arrived like a margin call. Volcker's rate shock crushed commodity prices, dollars got scarce, and countries that had borrowed short and in the wrong currency ran into a wall. A generation learned the phrase sudden stop the hard way. Policymakers tried to choreograph fixes with set-piece accords. In 1985, at the Plaza Hotel, finance ministers agreed the dollar was too strong. They coordinated talk and intervention to nudge it down and give exporters air. 2 years later, the Louvre Accord tried to put a floor under the slide to avoid chaos. The message: we can't change the system's core incentives, but we can smooth the edges when exchange rates wander too far. It worked for a while, until the next imbalance built. Meanwhile, elsewhere, pegs snapped like guitar strings. Mexico's 1994 devaluation, the tequila crisis, showed how quickly hot money would reverse. Then came the Asian financial crisis in 1997-98. Thailand's baht broke, Indonesia spiraled, Korea scrambled. The pattern rhymed with Latin America. Foreign currency debt, fixed or quasi-fixed exchange rates, banks funding long-term projects with short-term lines, and a dollar that strengthened just enough to make the math cruel. IMF programs arrived with conditions. Austerity cut deep, growth models shifted. The lesson most of Asia took was blunt: build war chests of reserves so you never beg again. How do you build reserves? Run surpluses and buy treasuries. Currency wars didn't declare themselves with trumpets. They arrived in policy nudges. A country eased to boost domestic demand. Its currency fell. Neighbors saw exports threatened and eased too. Competitive devaluations wore polite names, quantitative easing, forward guidance, but the effect was the same. When the U.S. expanded its balance sheet after 2008, capital searched for yield and poured into emerging markets. When the Fed later hinted at tapering, those flows reversed. The taper tantrum of 2013 wasn't about tantrums. It was about plumbing reacting to pressure changes from the issuer of the reserve currency. Europe's own experiment with a single currency layered new fragility on top of old habits. The euro gave exporters a stable platform and lenders a bigger map, but it also meant Greece and Germany shared a rate without sharing a fiscal union. When the global financial crisis rolled into a sovereign debt scare, spreads gapped, banks wobbled, and the European Central Bank had to invent new tools. Securities markets program, outright monetary transactions to keep the project from tearing. Whatever it takes became a monetary doctrine because the alternative was watching a currency union test break up physics. Across these cycles, central bank coordination deepened. Swap lines from the Fed, those quiet channels to lend dollars to foreign central banks, became a lifeline. In 2008 and again in 2002, they expanded fast, proof that the offshore dollar system had grown too vital to leave to chance. Independence blurred when markets were at risk, mandates bent to the moment. The reserve issuer wasn't just America's lender of last resort, it was everyone's through trusted intermediaries. Here's a small scene that holds the pattern. A textile exporter in Vietnam quotes in dollars because buyers demand it. The firm hedges with a bank that taps a swap market that references U.S. rates. When Treasury yields fall, the hedge gets cheaper. When the Fed tightens, financing costs creep into invoices months later. None of those people vote in Washington, but their cash flows hinge on its choices. So the ripples weren't ripples, they were currents. Exporters gained predictability and scale, importers gained access and volatility, borrowers gained speed and exposure. Each crisis taught officials a new move: accumulate reserves, coordinate intervention, expand safety nets, rescue faster. Each fix etched another expectation into the system. If pressure builds, policy will flex. That's how currency wars became policy debates, and how a Sunday night decision in 1971 kept writing headlines in places the cameras rarely go. The Greenspan-Bernanke-Powell playbook. While those global currents gathered speed, the mood on Wall Street settled into a new assumption. If markets teetered, the Fed would step in. It wasn't a doctrine on paper, it was a pattern. They called it the Greenspan put, not because Alan Greenspan promised protection, but because after 1987's crash, after the savings and loan mess, after each market scare, he eased. Traders noticed. Risk-taking adjusted. Here's the cadence. The 1990s tech boom rose on optimism and cheap credit. When it cracked in 200, Greenspan cut. When 9/11 froze nerves, he cut again, down toward 1%, policy shock absorbers working in real time. The emergency rates lingered. Money searched for yield and found housing. Mortgage brokers wrote loans that assumed prices only went one way. Wall Street bundled those loans into securities, then into CDOs, carving slices that ratings agencies stamped as safe. Globally, surplus dollars from exporters and oil looked for assets and landed in that mortgage machine. The petrodollar loop quietly financed the boom it would later help unwind. It felt like alchemy. Risk transformed into paper, paper transformed into collateral, collateral transformed into leverage. Homebuyers experienced it as permission. A couple with thin savings signed for an adjustable rate mortgage. The initial payment fit, the reset would be tomorrow's problem. A builder broke ground on exurban cul-de-sacs because lenders financed every blueprint. Appraisers penciled in yesterday's comps as today's floor. In the background, the Fed flagged froth, but kept rates low to nurse a still fragile recovery. The put wasn't a speech. It was a cushion of expectations under every decision. Then the cushion tore. When short rates rose and teaser mortgages reset, delinquencies swelled. Securitizations that depended on smooth cash flows choked. The repo market, overnight financing that greased dealer balance sheets, buckled as collateral was questioned. In September 2008, Lehman failed. Panic went global in hours. That's when the playbook added a new chapter under Ben Bernanke, the Great Depression scholar who understood what collapsing credit can do. Bernanke moved beyond cutting short rates. He opened swap lines to foreign central banks so the offshore dollar system wouldn't seize. He guaranteed money market funds to stop a run. And then he launched quantitative easing. The central bank would buy long-dated treasuries and mortgage bonds in size, creating reserves and compressing yields across the curve. The message to markets was blunt. If private balance sheets shrank, the Feds would expand to fill the hole. That changed behavior again. With term premiums crushed, investors slid out on the risk spectrum into corporate bonds, equities, real estate. Companies refinanced at historic lows and discovered financial engineering as a growth strategy. Buybacks spiked. Startups floated on cheap capital. Meanwhile, savers in deposits and CDs earned near zero while inflation, even muted, nibbled. The negative real rate, quiet after tax, after inflation math, pushed capital toward owners willing to ride volatility. The politics bent too. Congress balked at fiscal expansion after the immediate crisis, so the central bank carried more of the load. Forward guidance turned press conferences into policy, promising rates lower for longer, so mortgage desks and CFOs could plan. Each recovery leaned on the same scaffold: suppress yields, boost asset values, hope wealth effects and cheaper finance would pull real activity along. It worked enough to avoid collapse. It also widened gaps for those without assets to ride. Then came 202. A virus shut down demand and supply at once. The old tempo meet cut talk wasn't enough. Jay Powell fused Bernanke's financial toolkit with Congress's fiscal firepower. Within days, the Fed restarted QE, opened emergency facilities for corporate credit and municipal paper, and reactivated dollar swap lines at scale. Congress wired cash to households and backstopped small businesses. It was coordinated, fast, and huge. Markets turned from free fall to rally before the body count peaked, but the bill arrived as inflation. With supply snarled and demand juiced, prices climbed the fastest in decades. The playbook pivoted. Powell hiked at the quickest pace since Volcker, shrank the balance sheet, and repeated that policy would be restrictive until inflation cooled. Assets wobbled. Housing felt the break, tech re-rated, cash regained a yield. Yet even in tightening, the expectation held. If a crack threatened the system's core plumbing, the Fed would patch it. When a regional bank stumbled on interest rate risk in 2023, a new facility let banks swap underwater bonds for cash at par. Stability first, then discipline, always that order. Across the arc, Greenspan's easing reflex, Bernanke's balance sheet expansion, Powell's rapid pivot, the through line is the same Sunday lesson scaled up. Without gold's discipline, money is policy. Policy became a standing promise to smooth shocks, even if the smoothing shifted who bore the cost. Asset owners learned the language early. Borrowers learned the timing. Savers learned to move or be moved. And markets learned to listen, not for metal moving, but for sentencing. Winners and losers of the Fiat era. Winners first because they wrote the rules. Governments gained room to act. In a Fiat world, deficits weren't cliffs, they were bridges. When growth sagged or shocks hit, Treasury issued, the central bank smoothed, and programs rolled. That flexibility extended incumbency. Policies could arrive fast enough to matter before elections, and pain could be deferred through funding at scale. Over time, fiscal and monetary arms started moving like a single body. In crises, coordination wasn't an exception. It was the plan. Banks and asset managers thrived as balance sheets swelled. Every new credit channel, mortgages, student loans, corporate bonds, needed origination, packaging, custody, and fees. The Eurodollar system multiplied dollar claims offshore. Global custodians and dealers sat in the middle, taking a slice. Asset managers rose on the back of retirement reforms. 401(k)s and IRAs pushed households into markets, nearly all by design. Index funds promised low fees and broad exposure. Alternative funds sold yield where rates stayed low. A world run on policy, signals rewarded those who could parse the next sentence from a central banker fastest. Petrodollar recycling deepened the pool. Oil exporters booked surpluses in dollars and turned them into treasuries, agencies, and later into global portfolios run from London, New York, and the Gulf. Sovereign wealth funds professionalized the flow. Their mandates sounded prudent: preserve and grow national savings. But the side effect was more depth, more liquidity, and more demand for the very instruments that let Washington run elastic budgets. That feedback loop lifted finance from service to center stage. Asset owners, individual and institutional, compounded. Real estate appreciated with each rate cycle that lowered discount rates. Equities re-rated as margins held and buybacks shrank float. Private assets rode the tide of cheap capital and scarce yield. If you entered early, timing did the heavy lifting. If you entered late, leverage helped until it didn't. The story most people recognize as inequality tracks that divide. Those who owned assets tied to policy enjoyed the tailwind. Those who held cash absorbed the headwind. Now the losers, or more precisely, those left to carry hidden costs. Renters paid through rising monthly checks that never built equity. Savers anchored in deposits watched negative real yields skim purchasing power. Wage earners outside profit centers saw productivity gains show up as cheaper products rather than bigger pay. The famous divergence, productivity climbing, median real wages drifting, wasn't a moral verdict. It was a system response to money management that favored capital over labor when bargaining power weakened and rates steered valuation. Retirement shifted from guarantees to guesses. Defined benefit pensions with their actuarial discipline receded. Defined contribution plans put market risk on individuals, many of whom lacked the time or buffer to ride drawdowns. Fees, even modest ones, compounded against them over decades. Outcomes scattered with luck. What year you retired mattered as much as how long you worked. That randomness felt personal, but it was structural. A policy-driven asset world asks every household to be its own endowment. Dollar hegemony layered geopolitics on top. The reserve currency delivered cheap financing and strategic leverage. Sanctions could bite without boots. Swap lines could calm allies overnight. But hegemony also required open capital accounts and deep markets that tolerated foreign influence. Factories and funds went global. Supply chains got long and brittle. When shocks arrived, pandemics, wars, embargoes, the benefits and fragilities showed up together. The same plumbing that allowed swift rescue also transmitted stress at light speed. Corporate managers learned to arbitrage the design. With rates low and rescue expectations high, optimal strategies tilted toward leverage and financial engineering. That rewarded owners and executives. It did less for headcount or capex outside hot sectors. The result was an economy that could print strong asset returns alongside ordinary wage growth. Households filled gaps with two incomes, debt, and side work, while balance sheets at the top quietly ballooned. Politically, stories sought simpler villains. Immigrants, offshoring, lazy workers, greedy bosses. Each explanation had pieces of truth. None captured the operating system. The Fiat era's core mechanism, policy-managed money, shifted how reward and risk flowed. When interventions became the norm, markets leaned into them. When rates stayed below inflation, borrowers gained. When assets were the escape hatch from negative real returns, prior owners climbed. Fragility rose with success. Each stabilization demanded more. Each guarantee pulled tomorrow forward. Public debt loads ratcheted, private leverage followed. The more the system relied on intervention, the more interventions it required to keep confidence intact. That doesn't make collapse inevitable, it makes maintenance permanent. The winners can fund the scaffolding. The losers feel the draft. And yet the map isn't fixed. Some households learned the rules and crossed lanes, buying cash-flowing assets, aligning fixed-rate debt with incomes, using skills as inflation hedges. Some companies invested through cycles and paid workers like partners. Some governments built buffers in fat years to avoid austerity in lean ones. The Fiat era's advantage, flexibility, cuts both ways. It can entrench divides. It can also build bridges if choices shift. Could the system change again? It already is at the edges. New rails, rival reserves, programmable money, and different energy maps test the old loops. The question isn't whether winners and losers exist. It's whether we notice the game's design and adjust before the next Sunday night arrives. BRICS, CBDCs, and energy shift. Cracks didn't show up as a single break. They spread as experiments. After years of living under a dollar roof, a cluster of large emerging economies started testing side doors. BRICS summits turned from photo ops into working groups about payment rails outside SWIFT, local currency trade lines, and a quiet accumulation of gold on central bank balance sheets. None of it toppled the system. It signaled appetite, optionality if a sanction, a shortage, or a shock froze the usual pipe. From their perspective, the logic was familiar. If oil had once anchored dollar demand, maybe energy could loosen it too. Russia began invoicing some exports in rubles or yuan after sanctions bit. China expanded swap lines with dozens of countries, letting partners settle trade without touching New York. India explored rupee settlement windows for commodities. The volumes were small next to global flows, but they were proof of concept that worked when politics demanded it. The message was abandon the dollar. It was be able to work around it. Central banks had their own lab project, digital currencies. CBDCs were pitched as faster, programmable cash with better traceability and lower costs. In practice, they were new levers. A retail CBDC could settle instantly, attach conditions to disbursements, or limit where and when funds could be spent. A wholesale CBDC could rewire interbank plumbing, collapsing settlement windows from days to seconds. Policymakers saw fraud reduction and inclusion. Critics saw control. Both saw data, and data becomes power in systems that run on signals. Meanwhile, energy itself shifted underfoot. Liquefied natural gas made flows more flexible. Cargoes could reroute where pipelines couldn't. Renewables scaled in rich countries, changing demand patterns and knotting commodities into metals like copper, nickel, and lithium. Nuclear crept back into plans as reliability gained weight. As the energy map diversified, the petrodollar's monopolistic hold on demand loosened at the edges. Oil still cleared in dollars by habit and depth, but new contracts, side letters, and bilateral deals flickered in other units when it suited both sides. Sanctions policy accelerated the search for alternatives. When Russia's reserves were immobilized, finance ministers in other capitals ran drills in their heads. If a political crossing triggered a freeze on dollar assets, what survived? Gold vaulted at home felt safer than digits in New York. Yuan holdings grew for trade with China even if convertibility felt tighter. Cross-border payment systems outside Western control gained political insurance value. The cost was efficiency. The benefit was sovereignty. Markets mirrored the drift. Shanghai's oil contract in yuan grew from novelty to a tool for hedging regional exposure. Middle Eastern exchanges deepened, listing energy derivatives and equity in firms that straddled barrels and bonds. Euroclear and Clearstream still dominated settlement, but domestic custodians in Asia and the Gulf flexed. The dollar remained the deepest pool. More swimmers learned alternate strokes. Here's the human angle. A Brazilian soy exporter started taking partial payment in yuan for Chinese buyers, then used a swap to cover local costs. The bank handled the hedge. The CFO slept better knowing one sanction couldn't freeze every receivable. A Nigerian fintech built rails to move remittances through stablecoins when correspondent banking fees crushed margins. Regulators watched warily, then adapted rule. A German utility signed a long-term LNG deal indexed to a basket of currencies to smooth procurement. None of them wrote a manifesto. They wrote contracts that matched risk to reality. Bitcoin slid into this conversation as a stubborn outlier. Not a state's money, not a company's liability, just a bearer asset on a network that doesn't ask permission. For some, it functioned as a parallel savings technology, volatile but independent. For others, it was a speculative trade keyed to liquidity cycles and risk appetite. Institutions kicked the tires. Custody matured, ETFs opened distribution, and balance sheets inched toward allocation. Whether it becomes macro, plumbing, or stays a niche hedge, its existence reframed a question. What if the base layer isn't issued by any government at all? The future won't arrive as a flag planted on a Monday. It'll creep in through percentages. 10% of a country's trade settled in local currencies here, a CBDC pilot that becomes permanent there, an oil cargo priced with a currency option, a reserve mix that adds 2 points of gold and 1 of yuan while trimming treasuries by 3. The dollar's depth and legal protections will still anchor most flows, especially in crises. That's the paradox. Alternatives grow fastest when seas are calm. Storms send ships back to the biggest harbor, but incentives accumulate. If exporters can diversify billing without wrecking margins, they will. If importers can lower FX risk in their supply chains, they'll try. If central banks can pay citizens directly during a shock with programmable money, they'll test it. If sanctions keep teaching the lesson that political risk sits inside the pipes, more economies will build backups. Optionality becomes habit, then habit becomes infrastructure, which brings the story full circle. The post-1971 world was built on a weekend's choice and the architecture that followed: oil, debt, and policy. The next version won't have a single weekend. It'll have 1,000 small decisions that together redraw the map. And to see where the lines are moving, you go back to the first move that taught everyone how plastic the system could be. Human stories, lives rewritten by 1971, start with a saver who trusted the rules. In 1972, Ruth, a school secretary, set aside $50 a month in a passbook account for a house. The bank paid her 4%, groceries rose 6%, gas went up again after the embargo. On paper, her balance grew. In the checkout line, it shrank. Each Christmas, she recalculated and moved the down payment target 1 year further out. She wasn't reckless. She was saving into a headwind she didn't see. 2 towns over, Louis and Marisol married in 1979 and found a starter home with an 18% mortgage. The payment felt impossible until 2 things happened. Wages inched up and rates fell through the 198s. They refinanced, 16, then 12, then 9, finally near 6. Their monthly nut dropped while their house payment stayed fixed in dollars and got lighter in life. When their kids left, they looked rich on a brokerage statement they never meant to have. Timing had been their biggest skill. In a factory belt city, Jerome watched the stamping plant shed shifts. Management cheered new machines, the line moved faster with fewer hands, productivity soared, his raise didn't. The company closed his pension and opened a 401k. Suddenly, the stock market, which had been background noise, decided whether his 60s would be lean or livable. A trade deal nudged the last contracts offshore. He took warehouse work. The chart said output per hour was up. His rent said otherwise. Angela, a nurse, did what everyone told her, invest in herself. The tuition bill rose each semester faster than her aide wages. She took federal loans, then private ones when the cap ran out. 10 years into her career, she earned well and owed more than she'd borrowed, courtesy of interest that ticked while she slept. Whenever she looked at a listing for a condo near the hospital, her loan servicer's email arrived like a reminder. Not yet. Then there's Maya, who saw the rules and played them. In 2012, she bought a tired duplex with a 30-year fixed loan. The payment was a stretch. She painted on weekends, found good tenants, and raised rent slowly as inflation nudged everything else. Her costs stayed mostly fixed, her income didn't. She learned to watch Fed pressers the way her grandfather watched baseball scores. When rates dipped, she refinanced and pulled just enough cash to fix the roof. A decade later, the building had doubled on paper. It wasn't luck, it was policy literacy. A small business owner, Ken, built a parts shop in 1995. Sales were lumpy, so he kept a line of credit. In 2009, orders collapsed. The bank pulled back. He survived by cutting, then got a PPP loan in 2002 and a wave of demand he hadn't seen in years. Prices rose, he raised his. Debt shrank in real terms without him touching the principal. He didn't love inflation. He learned it could be an accomplice if your liabilities were fixed and your revenues flexible. Meanwhile, Esh sent part of every paycheck home. Wire fees clipped a day's wages each month. In 2021, her cousin showed her a phone app that moved dollars as stablecoins. The money arrived in minutes. It wasn't a revolution, it was groceries on time. When her mother needed surgery, she moved a larger sum. The hospital didn't ask where the dollars cleared, they asked when. Across state lines, Darren rented for a decade, always a few steps behind a down payment that drifted away as valuations rose. He did the math one night. If his rent climbed 4% a year and deposits earned 1%, he'd never catch the moving target. So he bought a share of a REIT in his retirement account. It felt abstract. Then the dividends arrived, small but stubborn, like rent in reverse. What ties them isn't one moral, it's one operating system. Ruth learned that idle cash can lose silently. Lewis and Marisol learned that fixed debt is a tool when policy bends your way. Jerome learned that productivity gains don't guarantee pay. Angela learned that education without pricing discipline becomes debt. Maya learned to translate policy into moves. Ken learned that rescues and rate cycles pick winners. Esh learned that rails matter as much as money. Darren learned to own slivers when you can't own the whole. Behind every chart is someone adapting or breaking. Myths we tell about money. Inflation is natural. That's the first myth, and it sounds harmless like weather. But in a policy-run system, inflation is a choice among trade-offs. After 1971, real yields went negative in multiple eras, not by accident but by design. Rates sat below price growth to ease debt loads and encourage spending. Savers paid an invisible tax. Borrowers, including governments, got relief. Nature didn't set that dial. Committees did, with models, minutes, and votes. Gold was outdated. That line won the argument in 1971, but only half tells the story. Gold's discipline was crude, sometimes brutal, yet it enforced a limit. Promises couldn't outrun reserves forever. By the late 196s, the Triffin math was public. Foreign dollar liabilities towered over U.S. gold at $35 an ounce. Keeping convertibility meant choking global liquidity. Serving global liquidity meant breaking convertibility. Dropping gold bought flexibility, and it also removed a speed governor. The trade was real. So were the consequences. Debt doesn't matter. It just matters differently in fiat. When the currency is policy, rollover risk is the cliff and interest expense is the slope. As long as markets buy what you issue, tomorrow's auction funds today's promises. But the bill still shows up as interest costs that crowd other choices. The bet underneath is growth and confidence. If either slips, rates rise or budgets bend. Pretending the constraint vanished doesn't make it so. It moved from metal to math. Markets are free. They're freer than command economies and less free than their slogans. Backstops are now part of the architecture. Deposit guarantees, swap lines, lender of last resort facilities, asset purchases. The Greenspan taught traders a pattern. QE taught them a language. Moral hazard isn't a scandal in the shadows. It's the operating instruction that risk will be socialized when it threatens the plumbing. Prices are discovered in the open and stabilized backstage. Savers are prudent. They are, but the definition of prudence changed. In a world of recurring negative real yields, idle cash preserves nominal balances and loses purchasing power. Prudence means owning productive assets, staggering maturities, and matching liabilities to cash flows. That's unromantic, and it's unfair to people without a buffer. It's also the rule set after 1971. Tools like TIPS and I-bonds exist because policymakers know the default settings erode cash. Here's a smaller myth that props up the rest. Inflation is always bad. Ask a heavily indebted borrower with fixed payments. Modest inflation paired with anchored rates lightens the real burden. That's not a moral defense, it's the mechanism. The system prefers mild inflation because it greases adjustment. The political problem is who pays: savers, wage earners without bargaining power, late arrivals to asset ladders. Everyone feels the same CPI differently. Another, the dollar is safe because it's the dollar. Safety is earned. It rests on deep markets, rule of law, and predictable policy. Sanctions power and reserve demand come with maintenance costs, transparent institutions, credible central banking, liquid collateral. When those fray, optionality grows at the edges. That's not collapse talk, it's upkeep talk. Wages will catch up. Sometimes they do, in tight labor markets or sectors with scarcity. Systemically, the post-1971 record shows productivity peeled away from median pay. The gap didn't arrive because workers forgot how to work. It arrived because capital skimmed more of the gains when money, trade, and technology favored scale and bargaining power thin. Policy helped, tax codes, rate regimes, backstops, but the core was design. A credit-driven economy rewards balance sheets. Finally, this is all too big to matter to me. It already does. Your mortgage quote, your raise, your grocery bill, your retirement balance, each runs through choices made since a Sunday night in 1971. Myth makes those choices look like fate. History says they were decisions. And if decisions made this world, decisions can navigate it. How people can navigate a fiat world? Start with a buffer. Hold a few months of expenses in cash where volatility can't touch it. After that, treat idle cash like melting ice. Use instruments that at least aim for positive real returns. When inflation is hot, high-yield savings and short T-bills can outpace bank accounts. When it cools, extend cautiously. Own productive assets. Equities compound earnings. Real estate pairs fixed debt with rents that move. Don't chase yield, buy durability. Cash flows that survive cycles, pricing power, low leverage. Use tax shelters when you can. In a world that taxes cash quietly, compounding is defense. Match liabilities to cash flows. Favor fixed-rate debt on long-lived assets. Avoid variable rates that put the central bank in your kitchen. If you borrow, lock tenor you can live with. If you lend, as a saver, stagger maturities so you always have something rolling off. No duration. When rates rise, long bonds fall hard. When rates fall, duration pays. If you need safety plus inflation cover, TIPS and I-bonds tie principal to CPI. They won't make you rich. They keep you honest. Diversify across regimes. Mix domestic and international equities, real assets, and skills. Skills are the stealth hedge. Pricing power lives in scarce competence. Optionality matters. A certificate, a side business, a second language can be worth more than a small position in any fund. Read policy like weather. Watch deficits, energy prices, Fed guidance, and balance sheet moves. Easing favors risk, tightening rewards liquidity. Oil strength often rides with a firmer dollar and heavier global funding costs. Finally, write rules before headlines. Rebalance on dates, not vibes. Automate contributions, cap leverage. The system runs on policy. Your plan should too. The meaning of temporary. Lessons from 1971. Temporary is a soothing word. It promises a return to normal after we get through the rough patch. In August 1971, it sold a pivot that never pivoted back. The lesson isn't that leaders lied for sport, it's that incentives outlived intentions. Close the gold window temporarily to stop a run, calm prices with a 90-day freeze, slap on an import surcharge to force a reset. Each move solved a political problem in the moment. Each planted institutions, habits, and expectations that made reversal harder the next week, then impossible the next year. Systems ossify around solved problems. The weekend at Camp David turned convertibility into a switch governments could flip for stability. But once the switch existed, future crises reached for it faster. Price controls returned in gentler forms, guidance, caps, backstops. The import surcharge faded, but managed trade reappeared in accords and targeted tariffs. Meanwhile, the heart of the weekend, the end of redemption at $35 an ounce, freed policy from a metal constraint and bound it to a credibility constraint. To defend that credibility, authorities intervened more, not less. Constituencies formed in the space temporary created. Financial firms scaled to intermediate and expanding river of credit. Exporters and importers optimized around a dollar billing system that stabilized invoices and deepened hedging markets. Households learned to rely on mortgages and student loans that turned aspiration into amortization schedules. Politicians discovered that fiscal and monetary coordination could smooth the business cycle enough to survive election. No one voted to make any of this permanent. Permanence arrived as path dependence. There's a deeper pattern. When the constraint is hard, gold in a vault, politicians bend around it. When the constraint is soft, confidence in policy, politicians bend it. That doesn't mean disaster, it means drift. Over time, small choices compound. A guarantee here, a facility there, a speech that steadies markets when a number misses. By the time you look up, the temporary bridge is carrying every truck in town and the old road has weeds. The same math that forced 1971 still rules, just with new variables. Back then, it was foreign dollar liabilities versus a shrinking gold stock. Today, it's debt stocks versus growth and interest costs. In both cases, the tipping point isn't a headline. It's a margin where promises outrun what the system can support without new rules. And new rules, like the old, arrive as temporary fixes that become the frame. So the lesson isn't nostalgia for a metal anchor. It's humility about policy. Emergency powers stick when they deliver relief. Incentives outlast slogans. Interventions breed expectations that demand more interventions. Temporary is a claim about time. It becomes a claim about design the moment people build on it. The weekend that began in secrecy didn't just change how money worked. It taught every future official how flexible the system could be. And it taught everyone else to live inside that flexibility. By saving differently, borrowing differently, and reading policy like weather. What began as a pause became practice. What solved one crisis defined the next. And what was sold as a timeout became the clock we all run on. One weekend turned money into policy and policy into the quiet rules of your life. Rates, rents, raises, all set by choices you never voted on. If you want the unfiltered story behind today's prices, wages, and power, watch the next episode. Subscribe for more untold mechanics and the few levers you can still pull before the next temporary becomes permanent.